It seems to be that it's not just you that thinks that this is not going to last. HSBC, in fact, cutting their year-end price target to 3,500. What are your reasons?
Well, partially to add on just to some of the comments that Kathleen made, but a lot of it I also see as not just rate hikes, but also just the supply of the amount of debt that's out there. In particular, with the U.S. market, there's about an extra trillion worth of debt coming on because of government spending over the next year. Another half of a trillion through quantitative easing, quantitative tightening rather. And so that means that there are a lot more bonds for sale. Therefore, that pushes prices down and pushes yields up. And so it's just because of this massive flood of debt and the existing debt that's already out there at higher prices that can further put prices down, that would really also make bonds more attractive than equities and put just more and more headwinds on the equities. So for me, it's starting with the bond side. And I think as long as we keep seeing these higher rates, even if the Fed slows down their rate hikes, I think just the amount of bonds out there is going to push those rates even higher.
So how are you hedging when the bond markets and the VIX are screaming fear?
Right. So one of the hedges I put on is basically a bear hedge, so 3 times a bear hedge direction ETF. I think when it isn't unexpected that we have these types of rallies when the VIX goes over 30, which it did on Friday. I didn't expect a second day, but certainly, a 2-day rally is pretty normal when you get that peak type of fear from the VIX and down days. And we could still, like I said, there's still some major macro headwinds. And as we said before, the correlation today was very high. It was really a very macro trade. It wasn't fundamental. I think we still have some headwinds just with the high dollar, with a lot of multinational U.S. corporations that could deliver very disappointing Q3 results, as well as more negative revisions in Q4. And that's another headwind that I'm very concerned about, that we could still see some down days. I don't think we're out of the woods yet. I think we could still see some downward motion here.
Because you say we need bond buyers before we get equities buyers, so that rally needs to kind of proceed. What would be the catalyst that you see for that?
Well, I mean, the most easiest and obvious one is from governments. So, producing spending programs, reducing some of their quantitative tightening. So policy changes, right? So something that comes from our different governments. And I don't see the amount of debt that's out there, that's coming out there. It'd be very hard to come just purely from the institutional side. So it really needs to come from policymakers.
On the long side, where do you see the biggest opportunities? I know you're still looking at healthcare.
Yes. So not that I'm saying that we're out, and certainly I'm not. Like I said, it's just merely a hedge. It's just a small portion of my overall positions. But healthcare services is one area that held up very well in September. Is already looking very fairly valued. United Healthcare is one of my favorites. It really sort of just stayed stable during the downturn in September, and obviously is participating in the upside. And so I think these types of companies that really have stable growth at very reasonable, if not really bottom valuation prices, I think as long as, like, as we said, we're facing these headwinds with equities, that tends to put a lot of pressure on valuations. And so if you are going to get into equities, look for those really good value stocks with very strong fundamentals.